Welcome back to my channel. I'm the covered call guy, and today we came across a video called Covered Calls What People Still Get Wrong. I haven't seen it yet. I'm gonna do a full review. I'm gonna do a full analysis on my opinion on it. Right? It looks like, from what I'm reading, that from the title Covered Calls What People Still Get Wrong, that the video's central thesis is that cover call strategies are, quote unquote, destructive to long-term wealth. And from what I'm reading, I'm gonna go ahead and watch the video and just do a rebuttal, because I think he's completely wrong. Cover calls are excellent, wealth builders if you use it correctly. All right, so let's get started on the video, and I'll do my full analysis on it.
I was not planning on making another video on covered calls, but my last two videos started a lot of discussion that I think is worth pursuing. There are a ton of these products being launched in Canada, and I believe people are making serious errors in their assessments of them. I feel a personal responsibility to give some final comments. I think the best way to approach this is to respond to comments from my last video. I'll address whether covered calls protect you in a downturn, whether the new age of covered call funds are better than the old ones, whether I have any integrity, and why I keep coming back to this topic. I'm Ben Felix, Chief Investment Officer at PWL Capital, and I'm going to tell you one last time why covered calls are destructive to long-term wealth, even if you need income from your portfolio.
All right, so right off the bat, it seems like this video's entire premise is a fundamental, error, right? It invalidates the benchmark of a risk management and income generation strategy, against a pure buy and hold wealth maximization. So already 43 seconds in, and it really looks like he's going to be talking about explicit design for different goals, right? Generating cash flow, volatility, mitigating return risk. So right off the bat, I already feel like he's off to a start where he's completely biased.
The financial product landscape has come full circle. For decades, actively managed mutual funds siphoned dollars out of investor pockets and into the financial industry without offering much, if anything, in return. Eventually, investors started to realize that paying 2% or more to own actively managed mutual funds sold by commissioned salespeople was a loser's game. At first, that led people toward low-cost index funds, slowly, which was a good thing. But now high-fee products that look different enough from traditional actively managed mutual funds, while carrying many of the same issues, are being promoted by unlicensed financial content creators. I have a lot of sympathy for the people using these products, being sold on these products. They're being sold hope, they're being sold a better future, but I don't think they understand the true costs. I want to read you a quote that has stuck with me since I read it a few weeks ago. Capitalists respond to the actual demand for their products, not the demand that would exist if people were perfectly rational and truly understood their own best interests. Since people's demands are driven by the benefits they perceive rather than the benefits they actually get, the financial system supplies too many products with exaggerated benefits and too few products with underappreciated benefits. And since perceived costs rather than actual costs drive people's demands, the financial system supplies too many products with hidden costs. I need you to think about that. It comes from John Campbell's new book, Fixed. Campbell's a professor at Harvard and one of the top living financial economists. He's basically saying that capitalism...
So right off the bat, Ben is already citing, John Campbell's book, Fixed, which suggests a financial system is exploiting investors' irrational demand for income of high fees, right? Complex products, right? So this miscategorized irrational demand of a specific investor. For example, a retiree or someone that wants to retire, right, in the decumulation phase, this income is not irrational. It's not an irrational bias. It is a critical requirement to mitigate sequence of return risk. The financial system is supplying a product that solves a complex problem, right? That a simple index funds, creates for this specific demographic, myself included, and many others, right? So right off the bat, he's nitpicking a certain book, he's already going off. Well, this should not be for anybody unless you're retired or about to retire. So He's already nitpicking certain demographics, a group of people.
Doesn't work properly when people don't know which products are good for them or how much those products cost. When it comes to covered call funds, people seem to want them because they are so psychologically attached to income, even when the income comes in a package that makes them worse off overall. Capitalists, the fund companies, are more than happy to meet this demand because they can launch products that cater to investor biases while charging a high fee for the service. There's no money to be made in low-cost index funds, so it's not surprising to see this shift. Something I didn't appreciate when I started making videos on covered calls is that there is a whole cottage industry of unlicensed financial content creators promoting these products, and in many cases selling access to coaching sessions or research to help you build your covered call income portfolio. Financial markets and financial advice are regulated for a reason. Regulation in Canada has not been perfect, and our long history of high-fee actively managed funds being sold on commission is a blemish that will take decades to recover from, but taking advice from unregulated content creators with limited financial background is risky business. There's nothing inherently wrong with selling options. Where I take issue is with these products being marketed and sold on their yields as if the yields were returns, when in reality, the yields are at best irrelevant and more likely have a negative relationship with expected returns. Okay. On to the comments.
Okay, yeah, yields are not returns. Okay, so Ben asserts that the yields are at best irrelevant and that income from cover are financial BS. The claim is only true within the video's flawed total return only framework, right? So he's saying that yield, which is the option premium, is the explicit mechanism for risk reduction and cash flow generation. The premium is harvested based on the risk premium, which a lot of people would agree is a persistent source of risk adjusted returns, right? The premium is the payment received in exchange for capping the upside. It's a core trade-off, not a trick. No one is getting tricked, right? So if you were just buying based off of the yield, then that is your issue. You're not doing your research, right? If you're just listening from a YouTuber online, I'm not giving financial advice. I'm just doing my due diligence, my opinion. And if you were just to take my videos and say, okay, I'm gonna invest in this. Okay, this is a great ETF of stock because I said so, without doing your research, then you're wrong. You have made that mistake of not doing your own research, your due diligence, right? Not knowing what you're buying. As long as you've done the research, know what you're buying, right? Then it's not a trick. All cover call ETFs have a core trade-off, and that's capping the upside. It's not a trick. It's not like they're hiding it from you. So, rebuting that point.
Let's start with covered calls in down markets. In my last video, I showed 5 examples of covered call funds underperforming their underlying equities when monthly withdrawals are held constant at the distribution yield of the covered call fund.
Yeah, like I said, that's the trade-off. You're buying covered call funds for the income, not because it could 5x, 10x, 20x. Buy the underlying if you want that.
In those examples, the investor in the covered call fund and the underlying fund were spending the same dollar amount at the same time intervals. I did include the 2022 downturn in my previous examples. Going back further, the Invesco S&P 500 Buy Right ETF started in December 2007, just in time for the Great Financial Crisis. I set up a similar side-by-side comparison of the covered call fund and an S&P 500 index fund. Spending from both portfolios in this simple model is matched to the distributions of the covered call fund. To be completely clear, both sides of the comparison are spending the same dollar amounts, which is based on the covered call fund's distributions. Keeping in mind that this is one of the worst periods for the US stock market in recorded history, we do see that the covered call strategy is helpful. It slightly reduces the downside. However, the covered call fund quickly falls behind as equities recover. The option premiums from selling calls are creating a bit of a buffer when stocks are down, but writing those options into an eventual recovery is destructive to wealth because they limit upside participation. Over the full history of this fund, including the Great Financial Crisis, the COVID crash, and the 2022 decline, and holding spending constant for the covered call fund and the underlying equity fund, An investor in the underlying would have 3.8 times the amount of wealth as an investor in the covered call strategy at the end of September 2025. What is
Okay, so Ben is saying his primary evidence is that if an investor in the S&P 500 has invested since 2007, would have almost 4 times the wealth of an investor in a cover call fund that he chose. PBP, which tracks the SIBO BMX index, right? So this is a deliberate act of analytical cherry picking. He is cherry picking exclusively the single worst case market environment for a cover call strategy. Why didn't he go back further? Why didn't he use a more current time? The 2007 to 2025 period is one of the longest and strongest low volatility bull market in history. He's showing the chart here, right? Cover call strategies are known to underperform in strong trending bull markets. It's like I said, it's that's the trade-off. You cap upside. Not all cover call ETF will cap the upside, right? GPIX, GPIQ, their strategy, right? They only do 25 to 75% of their cover calls, and they could capture some upside and some downside, right? Ben ignores the bear markets, right? If he does a full analysis and shows the exact opposite is true in other markets, like 2008, great financial crisis, the S&P was total return was like negative, like 40% or something like that, right? The BMX index, the one he criticized, was only like negative 25%. The strategy provided a 10% defensive cushion, so he's nitpicking there. And then we have what he showed here, the 2022 bear market. The S&P total return was about negative 20%, and the BMX index was about negative 11%. Right, the strategy provided almost a 7% defensive cushion. And on top of that, Ben is ignoring flat markets. The cover call strategy is designed to outperform in flat and rebound markets. So he's cherry picking a lot of points.
not relevant here is whether or not you had to sell shares in a down market to fund your spending. This is a tough one to grasp, but it's really important. Let's look at JEPI as an example. I will walk through this in excruciating detail. I'm sorry, and you're welcome. Let's step back in time to May 2020. JP Morgan launches the JP Morgan Equity Premium Income ETF. You have a bit of extra stimulus cash kicking around, so you buy $1 million of JEPI. I know that's a ridiculous amount for stimulus cash, but bear with me. That's 20,000 shares of JEPI at the share price at that time. You spend all the monthly distributions from JEPI, but you don't touch your 20,000 shares. Your neighbor puts $1 million into IVV, the iShares Core S&P 500 ETF, on the same day. That amounts to 3,355 shares of the ETF and a little bit of cash left over. Your neighbor matches all the spending that you're doing from your JEPI distributions through a combination of IVV's quarterly dividends and selling off shares of IVV each month. For example, your first distribution from JEPI is $9,882, while your neighbor receives a $4,230 dividend and sells 17 shares of their ETF to bring their total cash, their total spending cash, roughly in line with yours. Fast forward to September 2022, and IVV is down a lot from its recent peak. You receive an $11,178 dividend from JEPI, while your neighbor has to sell 28 shares at a depressed price to match your spending. This seems really bad for your neighbor, but what happens next is important. Your neighbor continues to sell IVV shares to fund their spending, but the value of their remaining shares is increasing faster than they spend. You still have 20,000 shares of JEPI, but their value has barely increased since you bought them. Keep in mind that you and your neighbor have spent the same dollar amount from the portfolios. Covered calls were successful in this example at avoiding selling shares in a downturn, but they also capped upside participation significantly, resulting in less wealth overall, holding spending constant. I saw a lot of comments saying, well, what if you sell your last shares to fund your spending? To which I would ask, what if the value of your constant number of shares declines to zero? Two different ways to arrive at the same outcome. It's the number of shares multiplied by the price that matters. Either one on its own contains very limited information. As these examples show, covered calls do offer some protection in a falling market due to the option premiums generated by selling calls, but I can't tell you when the market will fall, or more importantly, when it will recover. I get the appeal of living off the income in a down market, but when the cost of that income is missing out on expected returns both before and potentially more importantly after a stock price decline, it is increasing, not decreasing the risk of your ability to pay your bills in the future. Remember, covered calls look a lot like holding a large portion of your portfolio in cash. That can look good over some periods when stocks perform poorly, but in the long run, it is expected.
Again, he's saying in the long run, you're missing out on wealth. Right. Ben is arguing that missing out on expected return increases the risk of being unable to pay bills, that reinvesting distributions doesn't help. He's missing the fact that this substitute one definition of risk opportunity cost for the one that the strategy actually addresses. I mean, you invest in covered calls so you never have to sell shares, so you can live off of it. You aren't buying covered calls so you can not miss out on the growth, so you don't miss out on, the 10x recovery. That's not the whole point of covered calls. Again, he's cherry picking. He's saying you're missing out on wealth. No, that's not true. You collecting premiums is and reinvesting. When it does shoot back up the market, right? Depending on what cover calls. Again, not all cover call ETFs are made the same. So, yes, there is a understanding that cover calls, which whenever you buy, is different. They act differently. They aren't the same.
To be very expensive. Another interesting question is whether reinvesting rather than spending the distributions gives covered calls a magical advantage in a market downturn, as Andy suggests in a comment. As you can see here, with dividends reinvested, it does not make a difference to the general story. Covered calls continue to dramatically underperform when both sides of the comparison are left to accumulate and reinvest their distributions. One of the mistakes I think a lot of people are making with these products is thinking, as Andy suggests, that covered calls allow you to spend more in retirement or retire sooner with less savings. The only way this is true is if there was no other way, psychologically speaking, for you to spend your own money. That aside, covered calls result in lower, not higher sustainable spending for long-term investors for the simple reason that they reduce expected returns. Addressing the questions about when covered calls may or may not shine was important. There were also
Again, another fact that Ben is missing is that is factually incorrect, right? He asserts that cover calls result in lower, not higher, sustainable spending. Right? So that is actually the exact opposite of the truth, because it completely ignores the sequence of return risk. Right? Using his own model in 2022, the S&P 500 dropped almost 20%. A retiree using a simple index fund who needs $50,000 for living expenses has to sell about 20% more shares to get that cash. He's a retiree would have been forced to liquidate at the worst possible time and then permanently decimate the capital base. That's where the cover call solution comes in, right? The cover call strategy generates cash from premiums, and using his own bench chart that in 2022, the BMX investors portfolio also dropped, but by less. Using the cover call strategy, the investors that use the cash premium to fund their withdrawal, they're not forced to sell a single share of their underlying at the market bottom. Cash flow from premium is the mechanical solution, right? You're not forced to liquidate your portfolio. The strategy, the cover call strategy, enhances portfolio longevity and supports a more stable and sustainable withdrawal rate. Unless you're spending everything, which you shouldn't be, you should treat it like a paycheck and put some aside for taxes, and actually treat it as if you have to pay taxes and emergency funds and reinvesting. So unless you're just using everything, then yeah, I would understand. But cover call is a great solution for his own dispute on unsustainable spending, which is false.
A ton of comments from people claiming that I picked the wrong funds to analyze in my previous videos. The interesting thing to me is that most of the tickers that people offered up as superior performers and better representations of covered call funds as a strategy have similarly underperformed their underlying equities. These repeated interactions led me to believe, with all due respect to everyone watching, that many investors have no idea what their investment returns actually are. And that is an observation backed up by academic research. People really don't know what their returns are, which makes it hard to make good decisions. Let's go through all the examples that I was given. These first ones are US listed ETFs. SPYI, the NEOS S&P 500 High Income ETF, has trailed the Vanguard 500 Index Fund by 4.61% annualized since August 2022. Not off to a good start here. QQQI, the NEOS NASDAQ 100 High Income ETF, has trailed the Invesco NASDAQ 100 ETF by 2% annualized since January 2024. Not as bad. JEPQ, the JP Morgan NASDAQ Equity Premium Income ETF, has trailed the Invesco NASDAQ 100 ETF by an annualized 4.36% since May 2022. To its credit, in the 2022 downturn, JEPQ did better than its underlying, but any advantage was short-lived as it gave up the upside in the subsequent recovery. Okay, DIVO, the Amplify CWP Enhanced Dividend Income ETF, if I have any integrity. I had to put some effort into the underlying comparison here since DIVO is not an index fund. It holds a portfolio of high-quality dividend-oriented stocks. So it doesn't make sense to compare it to, say, an S&P 500 ETF. I compared it to the Vanguard Dividend Appreciation Index Fund ETF. They have moderate holdings overlap and a very high return correlation, so I think it's a reasonable comparison. DIVO has underperformed by an annualized 51 basis points since December 2016. I know I said an S&P 500 comparison made no sense here, but DIVO has performed far worse against that benchmark for whatever that's worth. QQQI, we did earlier, another underperformer. At least I still have my integrity. Okay, income and growth. Let's take a look. HYLD is the Hamilton Enhanced US Covered Call ETF. This is a Canadian listed ticker. Let's keep in mind that this fund does have a modest 25% cash leverage. It aims to be a higher yielding alternative to the S&P 500 with similar volatility, so I will compare it to an S&P 500 ETF hedged to Canadian dollars since HYLD is also hedged. It has underperformed by 0.9% annualized since February 2022. HDIV, the Hamilton Enhanced Multi-Sector Covered Call ETF, is a portfolio of primarily sector covered call ETFs with a sector mix intended to be broad.
Okay, a few points here. He's very misleading on the analysis of specific ETFs. Right, Ben talks about the ETFs SPY, QQQI, and JEPQ and DIVO, right, by presenting data showing they underperformed their benchmark over very short bull market time frames since May 2022 or January 2024. Right, his analysis, I believe, is very disingenuous. He's ignoring the 2022 bear market, which the entire reason these funds became popular in the exact scenario they're built for. Right, SPY versus SPY. Ben claims almost 5% on the underperformance since August 2022. But the fact is that in the 2022 bear market, SPY returned negative 3%, while the benchmark SPY returned negative 23%. So I don't understand, right? It provided a near 20% defensive cushion, and it also outperformed SPY in the third quarter of 2023. So he didn't talk about that. He's just, don't buy cover call funds because it will never outperform. DIVO versus VIG. I think Ben was claiming a 51 basis point of underperformance, right? That's not true. In 2022, DIVO returned a negative almost 2%, while the benchmark VIG was down like almost 10%. So the cushion is almost like 8%, working exactly as intended. And DIVO is not a traditional ETF or a cover call fund. I would say it's more of it's more of a regular ETF with a cover call option on top of it. DIVO is great is one of the best monthly payers. And then JEPI versus SP 500. In 2022, JEPI returned negative almost 4%, while the S&P returned negative like 20%. It dropped like 20%. So the cushion is almost a 15 point difference. And then QQQI versus QQQQ, Ben claims a 2% on the performance, which is statistically meaningless because the fund launched in January 2024. So using less than 1 year of a bull market data to prove a strategy's failure is not valid. Again, he's nitpicking and he's very disingenuous with this.
Similar to the S&P TSX 60. It has beaten the S&P TSX 60 as proudly proclaimed on the fund website, but this fund has a third of its assets invested in US equities. To make a proper comparison, I did my best to reconstruct an index fund portfolio matched to the underlying equities of HDIV. My model had no leverage, while HDIV has cash leverage of 25%. My model outperforms HDIV since inception. Properly benchmarked, I don't think this fund is beating anything. It's levering up for more downside volatility and still underperforming. There is an interesting discussion point here. This fund and its underlying equities are different from a Canadian market index and a US market index, and they have beaten both since inception. I would tend to say this type of short-term performance is unlikely to repeat in the long run. The evidence against active management's ability to beat the market in the long run is absolutely overwhelming. I would approach short-term performance like this with extreme caution, and note that if you believe in this specific sector and country mix, getting exposure to it without covered calls would be cheaper and have higher expected returns. The same thing goes for HHIS, the Harvest Diversified High Income Shares ETF. It is an equally weighted portfolio of 15 trending companies using covered calls and 25% leverage. This fund has not been around long, and for the first few months of its life, it only had 9 holdings. All of its holdings are single stock covered call ETFs from Harvest. I ran the portfolio of underlying stocks with no leverage and no covered calls. My weightings won't match perfectly, but I find that the underlying stocks have performed about the same as the fund. In other words, you were not any better off from the leverage and covered calls in HHIS compared to just owning the same stocks directly over this relatively short period. If I allow 25% leverage for the underlying stock portfolio, it has outperformed HHIS significantly, which again is exactly what we should expect when the effects of covered calls are isolated. Now, to be fair here, HHIS has beaten indexes like the NASDAQ 100 and the S&P 500, but let's keep in mind that we are talking about a fund that has existed since January 2025, has had as few as 9 holdings, and currently has only 15 holdings. It would be exceptionally rare for a concentrated portfolio of attention-grabbing stocks like this to deliver outperformance over an extended period of time. The vast majority of professional active managers underperform index funds in the long run. I see people online putting their faith into these products, and I find it really concerning. I honestly hope I'm proven wrong.
Well, yeah, you are proven wrong because we're not buying cover calls to outperform the underlying. Again, he's getting the cover call. The people that want to invest in cover calls, we're not trying to beat the S&P 500. It'll be nice if it could, match it or at times beat it, but we're buying cover calls for the income. But
at the very least, I hope that people recognize the risk they are taking. This is not a free lunch. Okay, that's the full tour of performance.
Again, free lunch. Like, what do you even mean by that? We understand there's a trade-off. The trade-off is that most of the upside is capped. Again, we are not trying to chase the growth. We invest in cover calls for the income.
Comparisons. Fundamentally, a covered call changes the shape of the distribution of expected returns in a way that I think is detrimental to long-term investors, and this shows up clearly in the data. Lastly, I want to address why I keep making videos on this topic. I have nothing to sell you by telling this information. If you listen to what I'm saying in these videos, you'll invest in low-cost total.
I'm pretty sure, is he not like in charge of a firm? What do you mean he's not trying to sell anything? I'm pretty sure if he doesn't want you having your own income and not needing his firm to help invest your money. I mean, there's always some catch to it. So I think that's also BS.
Market index funds, which I have nothing to do with personally or professionally, rather than high cost covered call funds, which I also have nothing to do with personally or professionally. So why am I doing this? Understanding complex financial products, both analytically and psychologically, is a huge part of my job as the Chief Investment Officer at PWL Capital. And I don't know if you know this, but telling strangers on the internet what you think you know about something is one of the best ways to assess and strengthen your knowledge. I actually gain a lot from making these videos and engaging in the discussions that follow. More altruistically, I want to see a financial product marketplace in Canada that isn't overwhelming, intimidating, or dangerous for people who are just starting out. The way that a lot of financial products, not just covered call funds, just a lot of financial products, the way they're marketed and sold makes it really confusing for investors to understand what they're buying, but also what they should be buying. Covered calls are a particularly challenging example because they cater to the strong mental accounting bias that many investors have.
I don't even know what that means, mental accounting bias. What does that even mean? I mean, that's just prerogative dismissal of a valid investment objective, because investors like myself trying to reach retirement are rationally and consciously trading paper upside for three tangible quantitative benefits: lower volatility, superior risk adjusted returns, and a non-capital depleting cash flow to solve sequence of return risk. Like, I'm not trying to chase the 10, 20, 30 year growth of the underlying. I don't ever want to sell my shares. I just want the income, and I can reinvest so that my next month there's more income, right? Again, I think he's nitpicking certain cover call ETFs that have destroyed the NAV, that are just juiced up on yield, right? There are a few names out there that have destroyed the cover called ETF name. Okay, you are responsible for what you buy and hold. So yes, there are a few, there are multiple cover call funds out there that have completely, they give 50, 80, 100, 110% yield, and then their NAV is just constantly, it never recovers, and it's probably going to zero. Like those cover call ETFs, like, yeah, if you buy them just for the yield and without any other further research, then yeah, Ben is correct on that. You're just destroying your principal, your capital. But there are great cover call ETF funds that has been stable with the NAV, consistent payout, even some capital appreciation, and has recovered with the downturns. So overall, I think Ben is incorrect. He's nitpicking, the years, the stocks, and I don't think he understands that people are buying this for the income. We're not buying this to chase, growth. If I wanted to buy Microsoft or Google, I would buy it because I know it's gonna grow over 10 years. But I'm not trying to work in 10 years. I want to replace my income. I want to live and use the income given to me now. So mental accounting, but I don't even know what that, like, it just sounds like he's throwing words out at this point. So that's my take on it. I think Mr. Ben here is completely wrong. Yeah, I think he's just very biased against the cover call ETF investors. He is correct in some investors just buying for the yield. So, if you don't do your own due diligence, then yeah, you're wrong in that. That's the risk you take. Other than that, I feel like cover call ETF funds are great. If you're following my channel, I currently yield $61,000 a year with a goal of $120,000, and I will be doing a breakdown of my portfolio. So this is just my analysis of a cover called ETF funds. This is strictly educational and entertainment purposes only. Please do your own research, and stay tuned.